Today, I'm talking about one of the most stable yet important verticals in financial services and what has become one of the most geographically diverse and competitive sector skills. Every year at Selby Jennings, we survey thousands of financial sciences and services professionals across the USA to benchmark salaries, the benefits they receive, and which factors would cause them to leave their company or entice them to join a new firm. Over the course of the next 4 weeks, we'll be releasing 8 mini episodes where we unpack the findings of this report with leading market experts from Selby Jennings. There's nobody better at all of Selby Jennings globally than to discuss risk management, today's topic, than Anthony McCann. If you're interested in reading the full report, it is linked in the show notes of this episode and available at selbyjennings.com. First finding that we had, first data point, is generally around risk pay in the market. It seems that a lot of the risk respondents were some of the higher paid individuals that responded to us. Is that something that you're seeing consistently? Has that grown? Obviously, sometimes risk can be a middle office function. Sometimes it can be a front office function. Are you seeing that, maybe compared to when we first started together, or when, even just a couple of years ago, that risk candidates are being paid more or being paid better or more competitively? What's your take on that?
Obviously, we've seen it all since we started, right? Only thing we didn't see is a crisis because we both were in high school then. But I think, from a standpoint, post-COVID, post-SVB stuff, right? We've seen a massive uptick in what candidates pay should be, and kind of realigning the market. Also, I think there's a lot more avenues outside of the standard financial services space for some of the more quantitative and analytical folks. So because of the competitive nature and alternative options, I think there's been a big reset in the market, and specifically some verticals.
Anything in particular? Is it in one area of risk more than another?
I think probably, ALM and Treasury, both in the first and second line, has been a pretty massive, growth opportunity post SVB. I think also, when you look at the wider businesses, on the buy side right now, there's been massive growth into their risk businesses and functions. And I think, for us, we've seen a big opportunity for candidates to reset their value, whether on the sell side or buy side, and have, options out there, right? I think obviously with the growth of the private credit market too, you're starting to see alternative options for people in credit risk at the bigger institutions too. So I think there's been a lot of, potential opportunities and avenues. There, even if you think about where risk has gone as a business, there's obviously other hubs that firms have gone to try to be a bit more cost conscious, right? And some of those areas, such as Charlotte, Dallas, Tampa, so to speak, but mostly I would say like some of the Charlotte, Dallas, Chicago's, are also paying really closely to some of the New York based markets, right? So I think that's something that have noticed, right? Across the board. So there's not as much of a discount as it used to be, given the amount of growth going into those financial hubs. But it's also giving a lot more demand for the risk talent there because, new clients are coming in, and, there's only a few spots to go get the talent from. So the more and more people that continue to come in gives a lot of those firms options. I think so. It is driving definitely big pay battle. And I think, historically what we were trying to see is a lot of the, 4 to 12 years experience talent is definitely the most in demand, and one of those that the clients are trying to keep happy and competitive, from that standpoint.
Yeah, all great points, and I think you're so onto something there. It's really interesting that what were originally thought to be strategic locations, right, or regional hubs, almost secondary. Obviously, like the companies that were establishing huge campuses there didn't foresee them to be secondary options, but maybe none of us saw coming that it would be as competitive as New York as far as bringing talent there and the pay. So yeah, that's a really good point. And that would lead me to believe maybe that a lot of our respondents might not necessarily have been outside of, or might not necessarily have been in New York. They might have been outside in those other areas, given that, they see that the pay has been really competitive or has increased from previous years.
No, for sure. I think also something to think about is the regulatory scrutiny. A lot of the firms that are approaching certain thresholds, the 100 billion threshold, the 250 billion, even 50 and 10, right? A lot of those firms need to make sure they are building out the right practice and in the risk side of the businesses, both first and second line. So that's obviously also driving some demands, right? And giving, some of them are starting to go after some of the bigger banks' talent, especially at the executive level to bring them in. And there's a lot of like exciting plans at some of these super regionals that they haven't had in, I guess, previous years. So I think that's also helping maybe reset the market a little bit too, to make sure that it is as competitive as possible, and more avenues and opportunities. And that's outside of New York as well, right? Majority of those firms.
For sure. For sure. So slightly moving on, staying with the comp stuff for a minute here. According to our survey, 66% of the respondents within risk management said to have received a salary increase this year. Would you say that's consistent with what you've seen about 2/3 of candidates? Would you say it's more? Would you say it's less?
Yeah, I think that's definitely reasonable. I also think that a lot of these teams have been running pretty lean, and given the market volatility over the last 2 years, I think some of the banks were constricted to being able to maybe spend as much or maybe get the right budgets or headcount into some of these groups across majority risk teams. So yeah, they've been working pretty hard. So you need to at least keep the people that are there pretty happy. And yes, they're probably getting salary increases. I think some of the challenges that come with in the risk space is maybe the increases aren't maybe as high based on even as we saw in our data, what they're getting in a year to year. It's pretty much a minimal base salary increase, which I think also is something to keep in mind for, because, when you're going to attract talent on the market, it's really, you got to be really conscious to make sure that you're giving them a competitive package to make them make a move to your firm. Especially giving a lot of our big banking clients don't move client candidates into roles and upgrade them a level, right? It's most of the time a pretty lateral move in title. Maybe there's a little bit of increased responsibility or visibility, but there has to be something that's going to make it a little bit more exciting for those candidates that are in there, especially when we know a lot of time the best candidates are the passive talent, right? And everyone's trying to keep them happy. So how are you going to stand out in the market to those passive candidates that might not be, eager to make a move?
Yep. Yeah. I mean, all great points there, and some really important, top priority kind of comments there. So you mentioned, right, 61% of the respondents, yes, they got an increase, but it might have been, up to 5% max. But that's kind of, that's kind of consistent and not unfamiliar with what we see generally, right? Once you're in a place, typically your increase is not nearly as big as if you were to make a move, right? Generally, if you're going external, anywhere from 10, 15, even 20% compensation increases we sometimes see, whereas year on year internally, it is, typically 3 to maybe 7%. So yeah, I think just because the feedback or the respondents say that most of them got a nominal or minimal increase doesn't necessarily mean it didn't align with their expectations, doesn't necessarily mean that they were disappointed by it, but also job hopping is frowned upon, right? You can't be seen to be seeking that 10 to 20% increase by going externally every single year. Yeah. So that all, that all makes sense. It's consistent with what we've seen for years, really. And yeah, that's what lateral recruitment is. When you make that move, you're probably moving most likely on title, the same on title for some comp increase and maybe some responsibility. But what our job is, right, and what we partner with our clients on is to promote the long-term opportunity, the long-term stability, the long-term career growth. Why making a move in the first place is the right decision.
For sure. I think the biggest thing that a lot of candidates want to hear is how they're being invested in, right? And not only what the role tangibly gives them now, but what does it look like long term? And, making sure that they're touching on points that they might not be getting at their current company, right? And I think, it's one of the reasons that we've seen a lot of the super regionals become maybe a potential exciting opportunity for some people that might be at a bank that's more BAU at this point. Some of the day-to-day work, and they can go in and fix problems, right? Some of the best risk managers in the world love to fix problems, right? And that's why, they are paid what they're paid to go in there and fix the problems. So yeah, I think it definitely is something that we've seen across the wider market. And I think, from our standpoint, the risk space is always going to be a crucial business for all of our clients, regardless of what's going on, regardless of who's in the office, and whatnot, and how that may affect the regulatory landscape.
Yeah. So quickly moving to the bonuses element outside of the salary stuff. So 76% of the risk respondents said that bonuses aligned with their expectations. That doesn't necessarily mean they were happy or disappointed. It just means they met their expectations. Would you say that that's consistent with the market? And then second part of that question, were most risk candidates actually happy with their bonus payouts this year?
Yeah. So I think in the risk space, there's definitely usually a good alignment on expectations, right? About what they can expect. Usually it's, pretty transparent, even though majority of it is discretionary, depending on the level. Obviously, there will be guaranteed bonuses or not. But, I think what our clients do is like everyone kind of have a rough ballpark of what they're going to get. Obviously, their way firms pay are different, right? Also, I think that plays a bit of a factor across the street. Certain banks pay a bit more on the base, less on the bonus. Some firms pay a bit more focus on total comp and merit driven. And obviously, when you look at the buy side, right, it's very, very, very focused on your total comp and not as much, driven on the base salary. So I think it's, in risk, they're pretty good at aligning that because it's pretty consistent, right? It's not usually massively variable where you might see in some other businesses where it's very, very heavy revenue generating, but that also could be a big factor of like, whether someone's happy or not, right? If the business overperforms, sometimes it doesn't really always affect how much better the bonus is for somebody that's in a non-revenue generating seat.
Which we saw a lot this year, especially as the revenues came back, especially the front office revenues came back. We saw a lot this year that, kind of to that point exactly. Just because the revenues were up doesn't mean all bonuses were up consistently with that exact number that the firm generated.
Yes, for sure. And also it's something where, generally people might have got what they expected on bonuses, but because the revenues were up, I'm sure a lot of them were hopeful that they would even see a bigger bonuses. But the sentiment across the market seems to be bonuses were a lot better this year than they were the year before.
Most definitely. And that's been consistent. Fortunately, throughout this little mini series, throughout the feedback that we got on the survey and from various verticals, it seems that bonuses this year were certainly more positive than they were previously. A little bit of a pivot here. And I think as we get to wrap this up over the next couple topics, I want to talk more about the candidates and their benefits or their motivations and what they're looking for either in their next role or what they're happy with in their current. 88% of our risk respondents noted that they have some form of flexibility at work. Curious if that number seems high to you or if that is consistent and if you have any additional commentary on the broader return to office across Wall Street and if most risk candidates are in 5 days a week.
My read is 88% seems pretty high, like in theory, right? Like hearing that number, but it does seem like there have been a lot more notable clients that have remained flexible. Obviously, there's some bigger names and, so obviously news in the market around the JP Morgans, the Goldman Sachs, right? Around 5 days a week in the office. Obviously, the Freddie Mac news is pretty interesting as they're going back to 5 days in the office and they have some even remote employees 3 days a week. And I'm wondering how that will affect kind of the Fannie Mae aspect as well. But I would say that, majority of them have some flexibility, right? There's some clients that have a lot more flexibility. And we're kind of at a stage where, when we started, 10 years ago, this wouldn't even be a question that you would ask, right? Our candidates, right? It was just kind of, you were in 5 days a week, right? Remote roles versus, X, Y, and Z. And obviously the landscape has changed so much since 2020 that we're even at a point where we have some candidates that, if it's going to be in the office 5 days a week, they want to see more compensation than they would if they were maybe in a remote role or in the office 2 to 3 days a week. Depending, right? It really depends on certain people's situations, right? And, I think that plays a big factor. Also a lot of people, I think post-COVID moved to maybe different locations, are commuting and maybe a bit further away than they were originally from the area that they were located. So yeah, that does play a bit of a factor. And we're kind of in a day and age where, work-life balance is starting to become more and more meaningful to folks and individuals, where it was kind of known factor that you were, if you worked at X, Y, and Z firms or you were in financial services, and you worked at big corporate companies, that you were going to be able to put in the hours in X, Y, and Z. I remember, when we first started.
That's what Wall Street was, yeah.
Yeah. Remember CCAR season, we couldn't get in touch with any candidates or clients back in the day, right? They were busy, telling us they would have CCAR for breakfast, lunch, and dinner. So I definitely think that is. However, I do think that some of the firms have done a really good job of, articulating their stance on that. Like we haven't seen an abundance of like, the big banks losing candidates just because of that as well. Right. I think, there's some prestige that comes with certain firms and, that's kind of also who they've been. Right. Now I think if you went from fully remote and then next week kind of told everybody we need to be in office 5 days a week, you're going to really ruffle some feathers. Right. Where I think some clients have been a bit more consistent from the very beginning. But yeah, I think there's obviously some things that kind of go with that. What I have noticed is it seems like sometimes in certain clients and businesses that the kind of direct hiring team will drive that, and what's going on. But we're also, transparently have seen some clients that were super flexible and pretty open to multiple locations, really driving to get people back into the office and usually where their main headquarters is as well, a certain amount of days a week too. So it really is client dependent. I think it also is skill set dependent and what you need, so to speak. So, and that's also how it is for candidates. Some candidates, this is really important too. Some other candidates, it's maybe not at the top of the mind. I think it really all depends on personal
Right.
situations. And that's
Right.
the benefit of, the way using a recruiter or working with someone is knowing and understanding your candidates and clients very well, right? And that's why we drove the business the way we have, right? And why our risk team has always been driven by specific niche verticals and understanding. You even know that we have someone that just does buy side recruitment because the clients are very different than our sell side clients, right? And that from their point is building their relationships over the years with candidates and as well as clients, you understand what matters to them, right? Which helps you go out and find the right type of people. Because there could be a perfect candidate on paper, for some of our clients, but based on what we know about how the client thinks and what's important to that candidate, it's probably not going to make sense. Or vice versa, it could be the perfect fit. So I think it's really important, and this is obviously was a new thing for us to adjust to post COVID of making sure that we're understanding and asking all of our candidates and also all of our clients to at this point.
Yep, 100%. I just want to wrap up with off the back of kind of, the recent bonus announcements. If you think that there's going to start to be more activity this year because bonuses were generally better than they were recently, so people might feel like they might kind of have the room to finally make a move, or do you think they're going to stay and there might be consistently actually less attrition as there has been previously? Do you think they're going to stay because now they feel a little bit more stable and secure at a place that is actually paying good bonuses again? Which way do you think the candidate movement is going to go?
Yeah, I think they're, having done this for, 10 years, there's always movement post bonus season, right? Regardless if it's exceptional bonus payout versus, low bonuses and whatnot. And there's always some changes that come within the organization. I think that the market, there's in specific verticals will have a lot more movement just based on demand needs than maybe some other pockets where they might be a little bit more maybe like, hey, bonus was good. I'm not seeing as much activity and volume out there. Maybe it doesn't make sense to consider a change right now. However, I think there's a lot more optimism and movement generally across the board, right? I think even for us as a risk team, I think across the U.S. between February and March, over 40 placements and $2 million worth of sales and for our candidates. So, and our, from our standpoint, which shows that demand has been there. Obviously there's certain bonus payouts kind of across the board for certain clients, and there's been a lot of broader activity in certain pockets that are obviously more important. I think that's something I've noticed.
Well, I would guess, or I would ask then, do you think from our activity in February and March, would you say that is attrition based or bonus based backfilling, or is it primarily growth hiring that you're seeing?
I think it's a combo. I think it probably sway a little bit more to some growth. Obviously, there's certain clients that have been hit with a little bit more regulatory scrutiny, right? That obviously need to grow and hire. But we've also seen a big, just general demand, even within, the larger consulting firms back and busy, right? And they're busy for certain requirements when it comes to the bigger banks, which means that if they're hiring, right, that generally is a good sign for the wider market. I think that's, for us, we have a good influx and diverse clientele. So it's, easy for us to kind of benchmark where we should be focusing our time and effort. So I think it's mostly been a good amount of growth, but there is obviously key attrition hires also that played a big factor. And there's been a lot of exciting movement, I think that
There
we've
has been.
seen at the executive level in risk across both the sell side and the buy side. which when there's changes like that, that does lead to obviously a lot of movement in the market. And the more people start hiring, right? And eventually the big firms that are hiring a lot, that leads to a lot of attrition based needs for the firms that also lose all the people as well. So yeah, I think it's going to be a pretty, active market in a lot of pockets within risk. Somewhat will be hotter than others. And I think, what we have made sure we've done a good job of is consistently, staying in touch with our clients and our candidates in each vertical and trying to understand the landscape consistently, right? And I think that's the way that we've always grown the business and always how we stay on top of what's going on. But there's a lot of exciting stuff going on right now across, the markets. And I think even when the markets are volatile, that's exciting times for a lot of our key clients on the buy side. And while it might be crazy for some people on the sell side as well, there's always going to be a demand and need for what's going on across those, wider businesses. Yep. And there's still a lot of uncertainty what's going on in the market with, just certain changes going on. But I think that's also going to be critical to make sure that we have the right risk practices in place, right risk frameworks, and why it will always be a crucial need. So we don't have to deal with something as crazy, and unexpected as COVID, with the financial crisis, whether it be, right? If you don't have a good practice and framework in place, you could obviously be in a challenging spot, across the board.
Yep. I think that's a great little summary and guidance from you, and a perfect place to close out. Obviously talked about quite a bit from your views and your team's views on what we're seeing as far as candidate excitement and candidate activity, candidate responses to their salaries, obviously, which is one of the leading and driving factors of whether or not they want to make a move. But we also talked about whether they like their current benefits or work flexibility and where that stands. So thank you for the insights and thanks for sharing that wealth of knowledge.
Thank you for your time, Jesse.
That's all for today's episode of Searching Smarter. If you found this conversation valuable, be sure to subscribe so you don't miss an episode. Until next time, keep searching smarter.